Welcome to This Is Money podcast. I'm Georgie Frost, and joining me and Simon Lambert today is Lee Boyce. And coming up, now that the energy price cap is coming down, we'll all be flush with cash. But where should we put our money now? Shares, cash, property, gold, unloved investment trusts? NS&I is hiking the rates on premium and green bonds, so what about there? We ask the experts. Also today, loyal pod listeners will remember the house price guru we spoke to 2 years ago, whose 18-year cycle theory predicted a crash in 2026. But have high rates made it sooner, or is the worst yet to come? Plus, why would anyone pay $25 million for a car? Don't forget you can stay up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app.
Don't forget, you can stay on top of what's going on in the markets by tuning in to the Digest and Invest podcast by eToro. Go to your regular podcast platform and listen on the go. Digest and Invest by eToro, the podcast for those interested in trading and investing.
But first, Simon and Lee have been promoted, which goes to show all of that knowledge and genius that they have packaged into this podcast has been recognised, and they are now, Lee, you're now editor, and Simon is publisher of This Is Money. Congratulations, lads. Well deserved. So, dear listener, you are in very good hands, but then you knew that, of course, anyway. Right, knowing where to put your money right now isn't easy. Everything has an element of risk. The stock market is erratic, property prices are shaky, and inflation has outpaced every single savings rate for almost 2.5 years now. And there's no guarantee the price of gold will go up either. So where would you put your money for the next 5 years? Well, This Is Money have been asking the experts. Welcome, Editor Lee. Welcome, Publisher Simon. Who did you talk to? What did they tell you? You've also got a poll on there. Where would your readers put their money? So while you're listening to Simon and Lee talk, guess where the majority of This Is Money readers would put their cash. Fixed savings, easy access, gold, stock market, or property. But what have you been looking at, Simon?
So, Ed Magnus, our reporter, spoke to 6 experts, genuine experts, I should add. There's a lot of people whom the tag expert gets attached in the world of people being quoted or giving their opinions. These are genuine experts, okay, genuine financial experts who covered sort of across the board. So we've got David Henry, who is an investment manager at Quilter Cheviot. We have got Rob Bentz, who is the co-founder of property advice website Property Hub and investment platform Portfolio. So he knows lots about the buy-to-let market. We've got James Blower, probably needs no introduction to regular listeners, founder of savings website Savings Guru. So he's the savings man. Okay. We've also got Andrew Hagger, who's a personal finance expert and founder of Moneycoms. Sarah Coles, who's the head of personal finance at Hargreaves Lansdown. And Charlie Lambert, who is the founder of the property website Best Agent. Now, they were given the choice, okay, and we limited the choice slightly. So we said to them, the options were fixed rate savings account paying between 5 and 6%, the stock market, gold, or property. Alternatively, they were told they could also adopt a wait-and-see approach and opt for an easy access savings account. So this is a similar decision to the one that people will be making themselves. Now, they might not have enough money to go out and invest in buy-to-let. Okay, because there's a big barrier to entry there because you've got to have a lot of money. The other options are pretty much open to all at a very, very low or zero cost. So a fixed rate savings account or an easy access savings account, that's not going to cost you anything. The stock market, you can invest in the stock market in a very, very cheap broad-based tracker fund and pay minimal, 0.1% a year charges if you want to get them really down as far as you can. Gold, you can very easily buy into a gold ETF. And then, so those are your options. So it's accessible to everyone. And the big thing is, and we've talked about this before on the podcast, we've written about it a few times, is that thing where you know that obviously over the long term, the returns from the stock market are said to be the best possible chance you have of growing your wealth and beating inflation. But you can look at our savings tables at thisismoney.co.uk/save. You can see all of the best independent, rates in our table racked up. And you can see that you can get a savings account fixed for 1 year that will pay you 6%. You get an easy access account that will pay you nearly 5%. That's, the 6% one is a guaranteed return. And not taking up a 6% guaranteed return, that's a quite a high hurdle. So anyway, David Henry, Quilter Cheviot, said, this is easy. I would choose stocks. Going back to 1985, over 5-year rolling time periods, stocks have beaten cash returns 74% of the time. Those are compelling odds. I think most people would be surprised that stocks have outperformed property historically, but they have. So he would do that. And actually, if you look at a lot of studies, for example, the best one, I think, is the Barclays Equity Gilt Study, which we've written about many times before. It shows, that investing in the stock market, broad-based stock market investing, is the best possible chance of beating inflation over time. Then you've got Rob Bentz of property advice website Property Hub. He would choose property investment. So we've got two people here choosing their own thing, right? Just to be clear. He said, although property prices have experienced a slight dip over the last 12 months, rents have risen and I can use a mortgage to enhance my returns. Additionally, inflation is currently eroding that debt at a rapid rate. But as we said, there's a big hurdle to getting involved in buy-to-let property. Mm-hmm. James Blower, fixed rate bonds are the best option at present, in my opinion. They're overpriced at 6% for a risk-free return is an excellent return by historic standards. People should keep enough money in an easy access account to have an emergency contingency, but I expect money that could be locked away will perform best in fixed savings over the next couple of years because they're going to be tough years for many people. Really interesting there that James said that, in his opinion, those fixed rate savings accounts are overpriced. Yeah. We'll come on to this in a bit because we're starting to see the edge come off those a bit as the interest rate panic is subsiding slightly. Andrew Hagger, again, if I had to choose where to put my money for the next 5 years, I think I'd opt for a fixed rate bond paying between 5 and 6%. 5-year fix. It's a safe bet, and with inflation expected to fall back in the coming months, they may even deliver a real net return come next year. Sarah Coles. Personally, I have strong cash holdings to cover emergencies and for planned expenditure over the next 5 years, so I would invest into a diverse portfolio using funds. If I had no emergency fund, I'd have chosen to save into an easy access account. The one thing I wouldn't do is hang on in an asset that didn't suit me, just in case something else got better in the interim. That's a good piece of advice. Inertia is often what causes people to miss out. They sit there either not doing anything or deliberately waiting, not inertia, because they're like, oh, things will get better, and then they don't. Charlie Lambden, founder of property website Best Agent. Okay, we're finally onto someone who isn't necessarily saying they do what their company does. Although actually, Sarah, I think, to be fair, is I would choose gold or silver to put my money in. 6% savings rates will be cancelled out by inflation. I expect a major stock market correction within the next 3 to 5 years as growing corporate debts become unmanageable. The property investment party of the last 40 years is over. Unless you're in the business of renovating property or being a cash buying professional landlord, which is a business, not an investment, then I don't see attractive returns from the property market any longer. So there you go. That's your roundup.
So you have a poll. What is it that your readers chose?
We have got in last place with 378 votes, the thing everyone in this country is obsessed with, property. No. Interesting. We've got inflation, we've got a bit of economic turmoil, we've got uncertainty, but even then, gold only manages to crack fourth place with 15% of the vote at 438 votes. Now, we've then got some even Stevens tie for second and third place with the stock market and an easy access savings account until things become more clear, both claiming 19% of the vote. Although actually the way the numbers work out and the rounding works out, the easy access savings account has slightly more actual votes. It gets 556 votes to 543 for the stock market. And in at number one, rebounding strongly over the past year and a half, bouncing back to the point where it has gone from getting an absolutely minimal return for locking your money up for a really long time to busting through the 6% mark. We have fixed rate savings, 35% of the vote, 1,017 votes. Interestingly, though, although the actual rates on those fixed rate savings accounts are considerably better than they were when they were knocking around the kind of 2% or 1.5% mark, you are actually losing money in real terms compared to inflation. But as we pointed out to you, crucially, okay, inflation is a backward-looking measure, fixed rate savings are a forward-looking measure, and there is a point where those two things are expected to cross over. And as was pointed out by one of our experts, people could be making a real return on fixed rate savings next year. Very interesting, and goes to show why all the stories we write on fixed rate savings are so wildly popular on the website.
With that in mind, Lee, I guess you weren't surprised by the outcome of that poll?
No, not really. I mean, you look at, I've been kind of keeping a track on sort of our traffic on the website, and the fixed rate savings tables have just gone a massive upward trajectory, as lots of people have obviously been hunting out the best returns that they can. And if you're talking about a return of 6%, as Simon says, risk-free, I think people would have just wised up to that and gone, do you know what? I mean, in an average year, if you're in the stock market, 6% would be lovely jubbly, really, wouldn't it? So, I think that that's how people are kind of thinking at the moment. I think there's a lot of veering towards fixed rates. But as Simon says, nothing currently still beats inflation, even though that inflation rate is falling. And we are starting to see the edge come off of fixed rates. So we've had a number of kind of backward movements actually in the last week. There are still some accounts that are paying 6% over the year, but actually interestingly, over the last few months where they have been going up, historically you would get a better return the longer term you fix. So if you were going to fix your money away for 5 years, which is obviously a very long time, without being able to touch that money, you have to be massively clear that you don't need that money for 5 years, would pay more than a 1 year fix, because you could get your money out after a year. But that's been completely flipped on its head this year, and actually 1 and 2 year fixes are still paying more than a 5 year fix now, and that's certainty. So I think it's a kind of messed up savings market at the moment, but people have wised up and have gone fully fledged into fixed rates. And if you think about that poll, 2,500 people voted on that poll, and 1 and 2 answers with fixed rate and easy access rates. I mean, could you imagine saying that a year ago? I would have thought that poll would be completely reversed, to be quite honest. I mean, I'm not surprised properties at the bottom, just because mortgage rates at the moment obviously playing a lot in people's minds. We're seeing house prices sort of edge backwards a little bit, not as much as what lots of experts have forecast, but it's still a bit of an edgy time to be getting involved into property. And look, landlords are being squeezed left, right and centre, really, and we're seeing that in the supply and demand stuff that's going on between tenants battling it out for homes. You'd have to be pretty brave, I think, at the moment to be getting into property. Lots going on there. So, and as Simon said, hardest one to get into. All the others you can get into with relatively low amounts. And the case for gold always comes up, the gold bugs, and when there's sort of financial turmoil and things going on, lots of people do head for gold. And we had a peak really for decades. Gold didn't really go anywhere. It was the financial crisis that started to push the price up, and then it sort of tapered back in sort of 2015-ish. It's been back on an upwards trajectory again, recently hit a record high in April, but it's tailed off again. So it's still a relatively safe-ish bet, I would say. Lots of people do like that kind of thought of a physical asset, and if it's not property, maybe gold is the one that people think of. But as with all these types of things, I think a lot of people think about, you've got to remember the question that we asked on the website was if you could pick one. But I think a lot of people at the moment, including myself, are in a bit of financial flux, where you think about the money that you can save each month and splitting that into different things and figuring out what's the best at the moment. All of a sudden we're kind of awash with better options, with easy access rates improving, fixed rates improving. If you've got a mortgage, whether or not you should be overpaying on your mortgage because you might have a low mortgage rate, all of those kind of things. You might have investments to stocks and shares or something like that, and you're thinking, well, maybe I should divert some of that money over here instead. And that's how I've been feeling the last couple of months. Am I making the right decisions? But definitely the worst decision you can make is to not act on anything.
Yes, not to
get too overwhelmed by all the choices and not going for it.
With that in mind, I mean, Simon, you don't obviously have to put everything into one of these, I suppose. I mean, it was the way that the polls worded, but is it better if you're going to go all in, or perhaps do a little bit of fixed rate savings, a little bit of gold, a little bit on the stock market?
Oh, 100%. I think that's an excellent point. Often these things are talked about in absolute terms. And obviously the way we had to ask this question was, if you could do one thing, what would you do? Because otherwise you're going to get a lot of answers that don't really tell you what that person favours, because everyone's going to go, well, I'd spread it, kind of thing. But in real life, you would spread it. And I would actually say to anybody looking at this, firstly, do your own research, make your own decisions, do what's right for you. Don't just follow what somebody has said in answer to a question in a story on a website. But secondly, they are informed views. Read what they say, think about it, use that as the jumping off point for your own research, but also maybe think about doing some of these things, not just one of these things, as you pointed out. And, you know, in reality, you can, if you think that you are worried about the stock market not doing that well. Now, ironically, after everybody thinking that this was going to be the FTSE 100's year, the FTSE 100, which is the one that we look at in the UK, but actually isn't the greatest representation of the UK. The FTSE All Share is better. The FTSE 100 hasn't done that well. It's suffered a bit. It's fallen. It's down about like 3% this year. The one that everyone thought wasn't going to do as well was the US stock market. And the US stock market has been going great guns. But that has been largely driven by a very small number of companies in the US stock market, which are the ones that everybody thought were the most overvalued and had suffered last year and were going to suffer again this year, which is this kind of magnificent seven. And there's been a new tech boom. When the last tech boom hadn't, you know, although those shares fell last year, they didn't really lose quite a lot of their expensiveness. So never underestimate the market's ability to wrong foot you. And also learn from the fact that that means year by year, it's very difficult to make these decisions. That's why people talk about investing being a 5-year time horizon type thing. But if you think you're worried a little bit about the stock market and what's going to happen, then you can just allocate more money to cash, for example. Traditionally, what people have done with their portfolios is they've done shares and bonds. And the simplest portfolio you can have is a broad-based global tracker fund that invests in shares all around the world. So you're not trying to pick winners. So when all of a sudden the Magnificent Seven in the States surprise everyone and go on a raging run when everyone thought they were going to tank, you haven't stuck all your money into the FTSE 100 because you thought that was going to outperform. So you get to benefit from everything. And then you buy a fund that invests in government bonds, which are the safest AAA rated government bonds in your own currency. So for us in the UK, we're really fortunate that we have government bonds that are AAA rated in our own currency. So gilts. So you buy into a gilt fund. And that's meant to be the safe bit of your portfolio. That has been, the apple cart has been very much upset there by the post-financial crisis, super low interest rate world, then COVID, rates being cut even more, quantitative easing, all kinds of funny monetary policy. And then it's been upset even more by the very rapid return to what used to be normal, but that has thrown everything into disarray. Now, ironically, there are some people in the investment industry saying that, actually now might be quite a good time to buy bonds, even though they've had this absolutely torrid time. But it just shows that safe bit of your portfolio has become quite risky for a number of people, because if you hold a bond to its maturity, you know exactly the return that you're going to get. But these bond funds don't hold bonds to maturity. They trade in and out of them. So it's a lot harder than it looks, on paper. So you might say, well, actually, in that case, I'm going to ignore the bond fund bit and I'm just going to hold that bit of my safe bit of my portfolio in cash. Or, and if it's going to pay me 6% and I know exactly what I'm going to get. Now, you won't get what they call the kind of the barbell effect of when stocks do well, bonds don't, but when stocks do badly, bonds do well thing that goes on. So the uplift in price. But what you will get is a safe part of your investments, your portfolio, your wealth, where you know exactly what return you're going to get on it. And then you can allocate the rest to the stock market. And even with the rest that you allocate to the stock market, you can put some of that into a global tracker fund. And if you want to go pick some interesting investments, you can use that global tracker as the core, and then you do these as little satellites around it, or you take higher risks with smaller parts of the portfolio. It's thinking about how all these things work for you. And that's really important. And just to give a little piece of real life practical, sort of a real life practical snapshot, let's call it that, of how these things can work. We moved home in 2020. we were one of those lockdown movers. We actually moved out of our flat just before lockdown was even a thing, and then bought a house in July 2020. The plan was always to do renovation work on that house, which is quite a lot of work, and we held off because building costs have gone up and everything like that. But anyway, we decided to do the building work. So we're doing the building work at the moment. We're out of our house for, it's a lot of work. We're out of our house for like 6 or 7 months. Fortunately, I'm in the fortunate position where my mum had enough space that she could let us go move in with her. So that's like the picture here, right? Now, with some of that money that we had to do that work, we've had it sitting there since July 2020. Now, in July 2020, you could earn basically nothing on that money in cash. So, okay, I was like, okay, right, well, look, I'm going to invest a bit of this money. So some of that money's been invested. Some of it was in savings accounts. What I didn't do was what actually we've been banging the drum on for years for people to do, and this was my mistake for not doing this with some of the money, is I didn't get as much of it as I should have done into ISAs, because I was thinking, well, I use my ISA allowance for my own personal savings, and so actually, but actually I don't use my whole ISA allowance every year. There's no chance my personal savings are going to hit £20,000 a year, my personal investments. This is a huge amount of money. So I should have shoved more of that money into ISAs, because then what happened, which is what we had warned for years, when people were saying, you don't need to worry about ISAs anymore because you've got your personal savings allowance. We were like, well, at some point rates are going to go up and all the personal savings allowance might go down or might vanish. Or you might become a higher rate taxpayer or something like that. And then all of a sudden, you are going to be paying tax on your interest. So I didn't get enough of it into ISAs. That's one thing. Then the other thing I did was I invested some of the money, which is fine. And some of those investments have done very well. Some of them haven't done so well. But now I'm left with the problem of what order do I take the money in? We're earning interest on money that isn't in ISAs. And I'm thinking, I wish that money was in ISAs and I wish I'd done that. So there's one lesson. The other one is, which accounts do I take it out of? The best thing to do is take it out of the non-ISA accounts first, because the ISA accounts at least are earning money tax-free. The investments then, the question is, at what point do I sell them? The ones that have done well, okay, fine, like cash that in, take the money now, take the money that's on the table. But the ones that have done badly, stock market not doing that well for some of the stuff that I've invested in. Like, do I just sit on my hands? Do I sit and wait? Do I try to spend that money last in the hope that those investments go up between now and like the end of the building, between now and having to pay for a kitchen, for example, things like that? But the risk I now run is that actually those investments go down, and all of a sudden I discover that I'm going to need to find quite a bit of money from elsewhere in order to pay for that kitchen. And that's why people tell you to be very careful about investing for shorter periods of less than 5 years if you know you're going to need the money, because you might come to need the money at a point when the investments are down. They might still be good investments. They might go back up in the future, but that might not be at the point when you need that money. So I don't know whether that is helpful for people, but it is a little kind of snapshot of how this plays out in real life.
Absolutely. Lee, should Simon have looked at premium bonds? You've written a little bit of an ode to premium bonds. Do you know why I think of that is because I remember interviewing someone who got a bounce back loan. Do you remember those?
Oh, yeah.
To help self-employed people. You wouldn't have to pay interest for the first year. So she got it. She didn't need it, but she got it as like a cushion and put it all into premium bonds. I think she got about 75 quid from the year, but it just made me think of that. So yeah, you've got an ode to premium bonds. Your newsletter, by the way, if you don't get it, do sign up for that, was also extolling the virtues of premium bonds, but you want to see a bit more of the big stuff.
Well, I was going to say, I wouldn't have been putting money in premium bonds in 2020, the cash that Simon had, just because the underlying rate wasn't great and the number of big prizes on offer, it just didn't make it very, very appealing. So I was mentioned earlier in the podcast about my financial flux. If you think about your finances in a kind of monthly way, just using 100 and then thinking about where you're splitting all of the bits and pieces. So at the moment, I feel very under pressure to be overpaying the mortgage somewhat, rates rock bottom. But then there's that danger of missing out of interest elsewhere because savings rates are doing so well. Then you start getting yourself all into like a little tiers. And then I've got my investments, excluding pension. There's all these things going on. There's lots of things to sort of weigh up at the moment. But one little grenade that's been thrown in to my sort of financial planning has been premium bonds. Now, I've always been interested in premium bonds. I've always thought they're a very uniquely British product, immensely popular. And people just love to be in it to win it. Let's face it, we all like that kind of feeling if you're in the premium bonds of it could be you that month and you can take your money out when you need it. I mean, I think that's a pretty fair deal. And what's made it appealing in the last year to me, and why I have been, when you're thinking about that 100, putting more of the percentage of my monthly kind of savings into premium bonds, is the absolute ramping up. And I think NS and I have done the right thing here of £100,000 prizes and £50,000 prizes. Now, for me, that makes it exciting. I never think I'm going to really win £1 million. There's 2 prizes per month. There's millions of people that are involved in premium bonds. A lot of people hold a maximum of 50 grand or hold, 10 grand or more. That's the odds aren't great. Let's face it. And the odds on winning £1 million haven't improved as more people have got involved. But if you think about it, so just delving back in time a bit, in May 2022, there were just 6 £100,000 prizes and there were 11 50k. The odds on that, again, pretty small. But in the prize draw next week, Georgie, did you know there will be 90 £100,000 prizes and there will be 181 50k prizes? That, to me, makes it much more appealing. Underlying rate will be 4.65%. Now that has given me a kind of nice little headache. We're like, well, should I divert some of my emergency easy access cash that I put in each month more of that into premium bonds? I'm even to the point of my regular drip feeding investments. I'm like, I might just put a little bit extra into premium bonds. It's just all these things that I've kind of been weighing up in my mind, and I think that this boost for September onwards has kind of tipped me over the edge of going, I'm going to start putting a little bit more into premium bonds. And what they've done and the way they've kind of funded this as well is that they've cut back massively on the £25 prizes, which, are you going to miss them? I mean, the thing is they fine balance it to make sure that underlying rate's right and they're paying out enough prizes on each tier level so it all works out. But to be honest, that's not what people are in it, is it? You're not really. You win 75 quid on your bounce back loan money. I mean, imagine if you won $1 million. Imagine if you won 100 grand with that, then you'd be like, okay, yeah. So that's the first thing about premium bonds. The other thing that I think, so I was just mentioning there, the £1 million odds, they haven't changed. So they bought £1 million prize in April 1994, and then they added a second £1 million prize in 2005. There's been an odd draw where there's been like an anniversary or whatever. They've thrown in a couple of extra ones, but on the whole, there's 2 prizes per month, and there have been for quite a long time. £1 million in 1994. I sort of crunched it through our inflation calculator. £1 million in 1994 is £2.4 million in today's money. So it doesn't look as attractive. It's not. I mean, don't get me wrong. I'd love to win £1 million quid. Of premium bonds, but I do think there's a conversation to be had of, do you shave out a couple of those 100 grand prizes and a few of the 50 grand prizes and have a third £1 million prize, or do you just say, actually, we need to ramp up these £1 million prizes and split the tier levels a little bit more, have maybe 2 £1.5 million prizes and a couple of £500,000 prizes, or a bit of a mix up in that kind of way? Because £1 million, like it's that Dr. Evil thing, isn't it? £1 million, and then or $1 million, and then it gets adjusted for inflation, and then later Austin Powers film is like $1 billion. It's like that,
Yeah, it's true, but I think I'd rather have the little wins, and often they keep us going, than because you're never going to.
I disagree. No,
we're different creatures, Lee.
Yeah, those little wins often I can get now from just interest on an easy access rate or a fixed rate. What I'm in it for is the big prizes. I want to win 100 grand. I want to win 50 grand. I think that is the mentality that a fair few people have. But listen, get in touch with us. I'd love to hear your views on it. And of course, with premium bonds, it's one of those things as well where you could be invested in it or saving into it for quite a long time and you don't win a prize and you're like, I've got luck, or it's rigged or blah 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 blah. But the reality is, with average luck, depending on how much you've got invested, you probably won't get a return each month. But when you do, and if you do get like a 4-figure, 5-figure sum, you're like, that's great. So has that happened to me? No. Have I been involved in premium bonds for a fair amount of time without winning a prize? Yes. Do I still think that I'm going to get some sort of prize before the end of the year? Yes. Do I think it'll be £1 million? No. Do I think it might be 100 grand or 50 grand? Well, I'll tell you what, the odds aren't absolutely terrible for that, but we'll I live in hope. I live in hope, Georgie.
Well, indeed, Lee. Indeed, I have to say, Lee, I've recently, a week ago, when I read your articles and saw all the rates bump up, I was like, do you know what? Do it, Georgie. Do it. So I put some money in premium bonds, Lee. But do you know what I don't like about it? And I thought this is what's put me off in the past. It is a really turgid process to get premium bonds. And I want a nice, funky app. I know I can just set up a direct debit, but look, as a freelancer, you get inconsistent income. And so sometimes I want to stuff a bit more in and I want to see where it is and I want to be engaged in it. But I want a funky app, Lee.
Well, I kind of get where you're coming from, and actually, there's been quite a lot of gripes, and we still get them now about logging into NS&I with the new 2-factor and all that kind of stuff. But personally speaking, I'm going to be quite frank. I do it on the desktop. It's really easy to log in, and you can just pay by debit card, and I've never had a problem. But I know other people have. Funky apps, come on, Georgie. We're going to do.
I'm down with the kids, Lee. I'm all about modern banking.
You just get an alert saying you've won this money, or you don't get an alert, which is probably more likely to happen.
But I'll just think I'll just think it's a scam. Like if I get a text message, I'll go, "Oh, it's a scam, isn't it? It's a scam." I want a funky app. Lee, before I ask Simon about investment trusts, I just want to talk about the green bonds quickly. They're looking quite tasty at the minute. Look, a lot of people will be thinking, because we spoke about fixed rate savings and how popular they are at the moment. You said they're slightly edging down. So people will be thinking, whoa, do I get in there now? But then we saw the green bonds that have come out. Was it 5.7%? That's pretty tasty, Lee, for 3 years.
Yeah, and actually, do you know what? For the first time, these green bonds are actually like an attractive prospect. And do you remember when they launched a couple of years ago? So much fanfare. There was a lot of noise about them, and NS&I kind of did the worst launch I can possibly remember, when they came out of a 0.65% rate. But it wasn't just that it was a 0.65% rate, which at the time, of course, is kind of where things were. But you've got to remember, we were of the age of the pensioner bond. Remember that? That went absolutely crackers those years ago. And he thought, well, maybe they're going to do something like this. This green bonds are for infrastructure projects. And I think that people are interested in putting their money into things that are treasury backed, that do perhaps make our country greener and better without being completely virtual signaling load of nonsense. It's just a simple way of going, here's a bond, here's your interest rate, put some money in it, and we're going to put this into some green projects across the UK. I think most people can understand that. Wind farms, whatever it is, just easy stuff, right? The issue I have with this product, and the issue I still have with it now, is that it's fixed for 3 years. Now, a 3-year fix is such a niche product. I mean, it is incredibly niche. Unless you know exactly what you need it for in 3 years, it's unlikely going to go for it. A 1-year fix, a 2-year fix, get it. 3-year fix is just downright strange. And I think that's what's put people off. But 5.65%, yes, you can get 6% elsewhere, but you'd like to think that the money that you're putting into this is going to go to good. So that's one thing. One thing you really do have to bear in mind on this: some NS&I products are tax free. So premium bonds, you win is tax free. With this bond, this is not a tax free bond. And actually, we were crunching some numbers on this, right? So if you put money, you'd be pretty vexed now if you put money into that first issue at 0.65%. If you put 10 grand in that, you're going to get, about 200 quid interest when it matures next year, because the money comes at maturity, the interest comes at maturity. So 10 grand, £200 interest for parking your money for that long. I mean, that just sounds now bonkers, doesn't it? But that was the world we were living in. 10 grand now with that 5.7% rate is £1,860 of interest, but it all comes in one lump. It's not spread out over each year. So there's a tax trap there to watch out for because of the personal savings allowance stuff. You could get stung there, depending on how much you earn, if you're a basic rate taxpayer, high rate taxpayer, additional taxpayer, all that kind of stuff. That sounds like a nice piece of interest, but if you're going to get taxed on it, it doesn't look so good. So you've got to bear that in mind. I think people sometimes people think NS&I tax free, but it depends what you're saving into.
Indeed. Right. Before we move on, we have one other place to look for where to put our cash. Your colleague Jeff Prestridge has been looking at the 6 unloved and cheap investment trusts you should perhaps consider. So what is Jeff saying?
Well, there's 2 things going on here. First of all, there's the opportunity for returns from long-term investing, which we obviously spoke about just now. But there's also the opportunity that investment trusts offer, because investment trusts can trade at a discount to the value of the assets that they hold. So different to an investment fund, which shrinks or grows as new money goes out of the fund or comes in. It has to basically invest all of that money at any given time. And its price always reflects the value of the underlying assets. An investment trust is limited by shares. It's traded on the stock market. And the managers of investment trusts don't have to be forced buyers or forced sellers. So what can happen is if there's more people who want to buy into the investment trust than there are shares, then that will drive the share price up and can drive it up to a premium to the assets that it holds. So you're basically paying more than what they're worth. But if there's not so many people who want to invest in the investment trust at times when sentiment is low and spirits are dampened, then there might not be enough buyers and the share price could fall, and it could fall to below what's called the net asset value, which is the value of all the assets that investment trust holds. And because sentiment has not been great over the past year, investment trusts have been trading at some fairly wide discounts. That makes them cheap. The value of the assets they hold isn't fully reflected in their share prices. And there's quite a few investment experts out there and analysts saying, look, some of these trusts look pretty good value. You shouldn't just buy a trust because it's on a discount, because some trusts just trade at a perennial discount. What you need to look at is how much compared to that perennial discount is the trust at, or does it normally trade at a discount, things like that. But you can buy into the global stock market at a fairly cheap discount, or you could buy into the UK stock market, you could buy into UK companies. And what you might be getting if you're buying into undervalued areas of the stock market is not only is that area of the stock market quite cheap at the moment and undervalued, but you're getting in even cheaper due to the discount on the investment trust. So Jeff's had a look at some of these. He's spoken to some experts and he's got some ideas. You've got Brunner, which is a global trust. The shares stand at a 13% discount to the value of the underlying assets. It's been around for 96 years. Its portfolio is quite racy in investment terms. It's got more than 40% exposure to US equities. And among its biggest holdings are Microsoft, United Health and Visa. Then a quarter of the portfolio is in UK stocks, with the big ones being Shell and Unilever. It's got a 51-year history of dividend growth under its belt, but it only pays a 2% dividend. So you can get those trusts that have long histories of raising dividends, but they only pay a very small amount out. Its performance is not spectacular, in all honesty, but it's not bad. Over the past 1, 3 and 5 years, it's done 3%, 44%, 51%. Over the same period, the FTSE World Index, which it's compared to, has done minus 0.7%, 31% and 49%. So it's beaten the market. Not hugely, but it has beaten the market, and it offers an opportunity to get in at a lower cost. Then you've got F&C, 155 years old, this investment trust. 11% discount. This is a super diverse investment trust. Low charges, 0.54%. You can invest all around the world. And it's got a humongous number of stocks in it. So because it uses different managers to manage different chunks of it, it's got more than 400 holdings listed in 35 different countries. But again, half of them are in the US. Bankers, that's again been around a long time, since 1888. It's a global trust. It's dividend friendly. Takes bigger positions in companies, so it doesn't hold as many stocks as F&C, for example. But performance has been underwhelming. That's due to less exposure to the United States. But the United States is one of the world's most expensive stock markets, and it might be that in the future that stops being the case and bankers could bounce back. Edinburgh Investment Trust. This is a turnaround story. Okay, this has been through the mill. It's not been doing very well at all. It's got new managers in place. Now, quite often when you see new managers in place come into an investment trust, they really shake things up, and performance can turn around. Again, charges are low. And it's trading at a healthy discount. And then you've got Monks, which is sort of the little brother to Scottish Mortgage. It's not quite as racy as Scottish Mortgage, got a slightly different approach, but the two are often compared. Again, trading at a sizable discount, annual charges, 0.3%, and this could be a good opportunity. And then you have Aberforth smaller companies. Now, this is an interesting one. So it invests only in UK smaller companies. That's quite a risky area of the market, but it's also an area of the market that is considered to be very undervalued. And then the investment trust is trading at a 14% discount. So you're getting potentially a double measure of undervalued. But don't just invest on the basis of discounts, because, as you know, things can stay cheap for a long time. And the stock market can prove you wrong for what's the old line? The stock market can remain irrational for longer than you can stay solvent. Is a classic one. You know, you got to be careful with this stuff, but they're very interesting. And I think, personally, I'm not one of those people who say, you should only invest in this kind of investment vehicle, you should only invest in that kind of investment vehicle. I think it's worth looking at investment trusts as well as funds, as well as trackers, as well as ETFs, as well as individual stocks. And I hold quite a number of investment trusts. I just like the way the structure means that managers are not forced buyers or forced sellers. You've got that extra level of oversight from having a board of directors who run it. They're not perfect, but they are quite a good way to invest.
That's it for part one.
I'm joined now by Sam North of eToro for our latest look at what's been going on the markets. Sam, how has the past week been?
Hi, Simon. Yeah, an interesting one. I mean, this week was always going to be driven by three things. NVIDIA earnings, the Jackson Hole Symposium, the comments that we got from that, and then also the PMI data. First, NVIDIA smashed earnings, but the move didn't stick. Share price on the day opened above 500, but finished around sort of 470. And to be honest, that left investors feeling a little bit ropey. It dragged down the S&P 500. It dragged down the NASDAQ. And we're now on track for minus 5% in August, which would be the worst month of the year. PMIs were weak. And we also in this week had a bit of a Bitcoin flash crash. So sentiment feels the worst it has in a while, but at the same time, we've had such a good first 6 months and the pullback has been due. Other interesting headlines from the week include Disney. It's trading at its lowest level in 9 years, and the dollar index has reached a 3-month high. So a bit of dollar strength heading into September.
And we've got a bank holiday on Monday, so it's a shorter week in the UK. I don't think they have a bank holiday in America. I must admit I haven't checked. But what do we have to look forward to next week?
Yeah, do you know what? I didn't check, but I'm pretty sure they don't. So we've got
apologies to any US listeners here for the complete lack of preparation by me and Sam on this.
Yeah,
we're pretty
absolutely
sure you don't have a bank holiday. Feel free to tell us we're completely wrong.
Yeah, or just pretend you're British and have one as well. And I'm not sure how your bosses will take that. But yeah, we've got the last few days of August to get through, and then September, as we've said before, historically the worst month. There's no guarantee it will be this one, but things maybe don't look too rosy right now. But we've had the good 6 months, as I mentioned previously, before the last sort of few weeks where it's gone lower. Bank holiday Monday, as you said, trade volumes likely to be affected then on the Monday. We've also got the US jobs report, which comes out on Friday, European inflation, which will be one to watch, especially from an ECB perspective. We're also really at the back end of earnings season, but we've got Salesforce, Dell and Lululemon to keep an eye on there. Overall, not expecting too many fireworks, but they're always famous last words.
Well, it'd be nice if we could have a good final few days of August, wouldn't it? Take at least a little bit off that big drop.
Yeah, that would be ideal.
Great. Thank you very much, Sam. Have a great bank holiday weekend.
You too, Simon. Thank you.
Welcome back. Right, just quickly, energy bills, the price cap, Lee, is coming down by around £150 from October. Good news, but apparently a third of us are actually going to be paying more for our bills, according to the Resolution Foundation, compared to last winter. And our cheery friends at Analysts Cornwall Insights reckon prices are going to go up again in January. But Lee, let's focus on the now. Just ever so briefly, because we have run through this on the pod, but I feel we need to have a little mention. What's the price cap? Why has it come down?
The price cap is going to be £1,923 a year for the typical home from October. Now, that's what they class as a house or a home that has typical usage. So some people will be paying less than that. Some people will be paying more than that. It's down to how much gas and electricity that you use. The reason it's been coming down is because wholesale prices have been dropping. So, we're through the worst of it, it seems, at first glance, when it comes to energy bills and the price cap being high. Because you've got to remember, Georgie, in January, just January 2023. I mean, honestly, things feel like it's been flying by. The price cap was at £4,279. Came down in April to 3,280. Then it was 2,074 in July, and now it's going to be 1,923. It's actually the first time it's gone under £2,000 since April 2022. It's actually the lowest it's been since August 2021. So that's all the good news in one nice little package for you. But of course, last winter we had the energy scheme in which the government gave everyone £400. Was split over the 6 months. So that helped keep people's energy bills down. But we don't have that same support this year. We still have the government's energy price guarantee. So that was launched in October 2022, which basically said that no one's energy bill would be over £2,500. And then this was up to £3,000 in July. So no one should pay a household energy bill of £3,000. But there will still be people that are potentially going to be paying more than last winter. Now, this week, I actually had an email through from my energy supplier saying that my direct debit was coming down again, which was a nice little surprise. I'm back to kind of where I was at, if I'm being honest. And of course, we're coming off the back of summer, but it's not been a particularly great summer, has it? I mean, I think the lights have been on and things have been used a little bit more than in previous summers in this household anyway. But it's winter where obviously this all becomes into sharper focus when people are struggling with their energy bills. Now, we've had some predictions from Cornwall Insight about where the price cap is going, and they are saying this is probably about as low as it's going to get. But we're not talking about mad hikes in the coming months as things stand. But as we know, things can change pretty quickly. But in fundamentally, this is fairly good news. And also, it might be good news for, of course, it doesn't affect small businesses, the price cap, because they don't have a price cap. But if we're seeing lower wholesale costs, hopefully that's getting passed on to small businesses. Some of those stories that you might not think about when you're going to a cafe or a restaurant or a shop, that are energy intensive, that have had to face quite higher energy bills, which has hit you all pound in the pocket because they've had to put on some of those costs onto customers. It all feels like everything's moving in the right direction, hopefully.
Should we fix if we find one?
You ain't going to find one, I don't think at the moment. No, it's unlikely that you're going to find one that's going to be long term worth it. I mean, check with your energy supply. There's absolutely no harm in finding out. Most of us, of course, have gone complete reverse to what we're used to, come off a fix, and we've been put onto these variable tariffs. But when we constantly ask the big energy firms what's going on with fixes, we're met with a kind of wall of silence. There have been a few that have come and gone. As in there's been a few okay-ish rates. But if you fixed a couple of months ago when the price cap was higher, it's unlikely that it would be as low as this. So that's kind of the advice at the moment. Ofgem's even sort of called people to be wary of fixed deals. So basically the chief exec of Ofgem saying anyone considering fixing should weigh up all the facts and consider what is most important to them, whether that's the lowest price or the certainty of knowing exactly what they will pay each month. It's important customers are comparing fixed deals with a new lower price cap announced today. Fundamentally, there's no, as far as I know, there are very few, if any, fixed rates that are going to be matching that price cap. So tread carefully.
Yeah, good advice there, Lee. Right, as I said in the intro, loyal listeners might remember a couple of years ago, Simon telling us about a prediction, I guess you can call it, from a chap called Fred Harrison, a housing market crash that would come in 2026. The British author and economic commentator identified the 18-year property cycle and believes it can accurately predict the next house price crash. But have today's inflation and high mortgage rates thrown the cycle off track? You caught up with him again to get his analysis of where we are headed and ask him if his prediction still stands. Simon, just a recap of the 18-year property cycle, and what did Fred say?
the 18-year property cycle. So the 18-year property cycle starts after each crash, and it's got phases in it. And it takes about 4 years to restart its upward trajectory again. So the market basically just stays in the doldrums. Then you get 6 or 7 years of modest growth. That's known as the recovery phase. You get a mid-cycle dip, which is often a 1 or 2 year downturn in the market, before a final boom phase ensues. That lasts for about 6 or 7 years. Prices grow more in that period. It's called the explosive phase, where they grow more than at any other point in the cycle. And then, you hit the top, the market crashes, and down you go again. Now, what's interesting about this is that Fred pretty much predicted the 2008 crash. Also, in his book, The Power in the Land, published in 1983, correctly forecast property prices would peak in 1989. So we first carried an article from Fred, I think going back like 2005 kind of time, where he forecast the 2007 peak, the 2008 crash. And then if you map what has happened since then, this is obviously not completely precise, but you can pretty much map it out as to what has happened. Now, the question is, what happens next? And have we pulled forward some of that explosive phase and compacted it into a shorter period, and now pulled forward the crash due to the fact that interest rates have gone up very, very sharply? Base rates gone from 0.1% to more than 5%. Mortgage rates have gone from, you could have been fixing for 5 years at 1.3%. You're now fixing for 5 years at 5%. There's a big, big difference between those. And the big difference is that most people need to buy properties with mortgages, and they simply cannot afford to pay the same amount for those properties that they could do a year and a half, 2 years ago. Now, the question of whether we pulled forward some of that was the absolutely nuts lockdown property price boom that we saw, which was the opposite direction to the one that most people thought the property market was going to go in COVID, especially after that initial freeze, not just caused by the stamp duty holiday, but exacerbated by the stamp duty holiday. There was a product of people suddenly deciding they could move, wanting a change. They'd been stuck in their houses. They were like, I don't want to be in this house. I want to be in that other house over there. Seeing other people buying and going, well, prices are going to only go up. Mortgage rates had absolutely tumbled. A sizable number of people had more money in their pocket because they were saving money on commuting and things like that. Not everyone, lots of people still had to go into their places of work, and they didn't feel any richer. All these things, then all of the money shoved into the economy by the government and the Bank of England. And of course, the stamp duty holiday, which wouldn't have been a bad thing if it hadn't have been an idea that had the word holiday at the end. If it had been a stamp duty cut that wasn't time limited, people wouldn't have felt the compulsion that I must do this before this date, otherwise I won't save the money. Of course, they ended up paying more for the house than they would have otherwise done because the extra they paid outweighed the stamp duty cut, and so on and so on. We know all this. But what that did was that created this whoosh upwards in property prices, which then interest rates suddenly shooting through the roof way more than anybody else thought they were going to do, has created this, which has suddenly cut things off. So what does Fred think? Well, fair play to Fred. He's absolutely 100% sticking by his theory. And he doesn't think that this has all been pulled forward. So what he says is that he sees the current downtrend as nothing more than a blip before prices once again continue hurtling upwards, and we've still got some mileage before we hit that 2026 peak. COVID was an interlude which jacked up prices prematurely, explains Harrison. They now have to level off to compensate, but the price trend will remain upwards with some temporary adjustments to take account of the exit from COVID and the fallout from Putin's war on Ukraine. The market is settling down to the stresses, but the upward trend in property prices is the only way to go, reinforced by the anti-landlord policies of the Tory government and Westminster's chaotic approach to the housing market. Contrary to popular belief, he also believes that increasing numbers of landlords selling up will actually drive house prices higher because their sales will help restore buoyancy to the market this year and do nothing to balance supply with demand, merely restrict the choice for prospective tenants. And he said another key factor that will propel prices higher is next year's general election. The Tories are not going to want to upset would-be home buyers any more than they have already done. Property affordability will remain a vote-determining issue. And he thinks property will still remain, seen as a safe haven. Land remains the best of all hedges against inflation. So interestingly, he still thinks that's going to happen, but also that the market is still going to crash in 2026. He says with elections coming in late 2024 and early 2025 in the UK and the USA, for example, governments will jack up the money flow and policies to ensure their trusted supporters continue to vote for them. Those subsidies will convert into increases in land values until 2026, when they will peak. House prices will increase by at least 20% before 2026. The sharp crash will then result from the ideological paralysis that will inhibit government responses.
Well, that's bold.
I know. Doesn't sound great, does it? It's like a double dose of bad news. House prices are going to go up even more from the point where, despite having fallen a bit, they're still phenomenally expensive compared to wages, and then they're going to absolutely tank. I mean, I'm really hoping he isn't right.
Yeah.
I'm really hoping that what happens is that house prices effectively stagnate, fall in real terms compared to inflation, but also, most importantly, fall compared to wages. And we get ourselves back to a position where making a decision to buy or move home was less like nipping down the casino and chucking a load of money on red or black.
Oh, well, absolutely right. Well, Lee, look, we have got some bad news, I suppose, at the minute. I mean, house prices have become less expensive relative to average earnings. This is according to new data, but of course, higher mortgage rates means homes are now less affordable, and Fred's prediction makes us all rather depressed.
I don't know what's going on with the property market at the moment, Georgie. It all feels very, very strange. The other week, there was a property that went for sale in my local area. I remember when it was sold a few years ago. It's a bungalow. It's not particularly impressive, and it went up for quite a high price tag. And I came home and I said to my wife, "You'll never get." We actually viewed this property quite a long time ago, and I said, "You'll never guess how much this property's gone up for sale for." And I told her, and she was like, "Wow!" And I was like, "There's no way that is going to sell for that price." Well, I'm a fool, because 2 weeks later that is sold for asking price, and I cannot believe it. And now it's got us thinking, well, if that's worth that, what's ours worth? And I think there's quite a lot of this going on. I think there's quite a lot of disbelief in people going, how's that selling? But I think it's a supply and demand type thing, and sometimes you read these kind of countrywide surveys and house price indexes, and then sometimes you feel like something different's happening in your local area, and you just can't quite piece it all together. Anyway, this Halifax research, which looks at how much homes cost relative to earnings, it's dropped to 6.7 times earnings rather than 7.3. I mean, that's still pretty high compared to historic rates. And if you look at the stats based on this Halifax research, UK average house price is £286,276, and average earnings are £43,090, hence that 6.7 times figure. And the average monthly mortgage now is £1,249. But there is a picture across the country which is different. Now, I don't think it will come to as much of a shock that in London, the house it has the highest ratio. The ratio is 9.3. And in the North East, the ratio is 4.9. I don't think that's going to come as much of a shock. But it still shows you just how difficult it is to get on the property ladder, especially if you don't have that sizable deposit that's required, and especially if you're not in a relationship or buying with someone else. I think again, it highlights how difficult it is, and it's a good measure. I think Simon's always been a fan of these house price to earnings ratios, because they paint a picture of what's going on. Now, you have to remember that basically this is a historic high. The last time they did this, it was a historic high, and in sort of 2010, 2011, that ratio was far lower. In fact, that ratio was at more like 4 or 4.5 times, which is what you kind of typically, I think, people are used to thinking about when it comes to buying a home, sort of 4 to 4.5 times salary. But it's a pretty bleak picture. I think still, and even though that figure has dropped, of course, higher mortgage rates have made it even less affordable for people. So why that ratio has gone down, of course, we have seen mortgage rates rocket. And if you're a first-time buyer, you're going to be facing mortgage rates that are far higher. I was actually having this conversation with someone the other day who's renting and said that they investigated getting a mortgage because they're kind of almost there with the deposit to buy a home, and everything is just kind of flipped on its head. You know, mortgage payments are way higher than rent for the first time in the whole time that they've been renting for the last decade. It's just it's typical luck, but you know that is things that people are facing up to. In the same breath, that same person told me that they've been told their rent is going up 30%, and if they don't like it, lump it.
Wow.
And that is a symptom of this current hot rental market in which it feels like everyone's kind of getting back onto the rental scene. I think there was Property Mark data this week suggesting that the number of tenants this year hunting for a home is up 39% compared to last summer. And of course, a lot of landlords are exiting because of a lot of limbo they're facing at the moment. The EPC rating stuff is just one thing off the top of my head. It's a much less attractive prospect, as the house price crash guy says in his piece. So there's a lot going on. It's a very confused market, I would say, at the moment for everyone. I would say for homeowners, for first time buyers, for renters, for landlords. It all just feels like a real sort of boiling pot of ingredients that I'm not sure maybe will lead to the 18-year cycle.
Maybe. Don't worry, first-time buyers. You've only got 3 years to wait.
Yeah, but again, we always say this when we talk about this, don't we? Like, don't be put off buying a home. Like, never be put off buying a home. You can't time the market. If you try and time buying a property, I don't think you'd ever buy one. I think you just constantly have sleepless nights thinking, God, how much am I paying for this? How much is this loan? All of that kind of stuff. I think as long as you've done all of your due diligence and are ready to buy, go for it. I would never want to be on this podcast putting off people buying a home. But all I'm trying to say is that there's just a lot going on. There's a lot going on, and we had from the pandemic until sort of last summer, it was all just trundling in this kind of mad freight train of house price rises and ultra low mortgage rates and all that kind of stuff. And that feels like that train has just sort of screeched to a halt. And now I'm not sure which track it's going to go down.
Indeed. Talking though, Lee, about things that are outrageously, ridiculously expensive. I went to a pub the other day. I have to share this story with you. I'm blown away. All right, it was a craft beer specialist type one, you know the ones, and it was in central London. But they had a pint on tap, and it was only 6.2%. And that's quite high. That's quite strong, but as in
quite strong
for the price I'm talking about, because I know it's only 6.2.
No, I get your point. I get your point. Yeah.
But I've seen ones that are like a lot higher.
No, I know you can get
like
double-digit one.
And,
Yeah.
Right? So
You're meant to sip and not like gun. Yeah, I know what
yeah.
I mean. Yeah,
it's from the Basque region of Spain, right? So it's not like Timbuktu or anything. £15.20 for a pint.
Oh,
right?
Wow.
There were not even gold flecks in it. I'm expecting this to have been carried on horseback, hand from San Sebastian. None of that, right? £15.20. So naturally I had to try it. I didn't pay for it, obviously. I got someone else to do that. It was nice. It was a bit sickly, but it was nice. But
it was a bit sickly. It'd never be a bit sickly.
It was a bit, But it just, it led me on to sort of like the most you would pay for anything reasonable. Why I'm thinking about this is because we have a story about a 25 million car, but we'll get onto that in a second. But you do get to a stage where you're like, no. And I'm thinking this with coffee, by the way, £4, and that's the limit for me. I'm done.
Yeah, I totally agree, Georgia. I have limits for stuff. I do. The trouble is, so for coffee, I always said I'd never pay more than £3 a coffee. Now it's really hard to get a coffee under £3. And I've had to raise that up to £3.50. I just come back from Paris, and a coffee there was really expensive. It was like €7-8 a coffee. I don't know. Maybe I was just hanging around the wrong places, but it felt like that was everywhere, even the sort of outskirt places that we were staying. I was the same with a beer. I remember a few years ago I said I'd never pay more than £5 a pint. Then that slowly became £6, and that's become £7. Bearing in mind our offices are Kensington, I would never ever pay £15 for a pint. But it would never be worth it. I'd knock it over or something would happen. But you're right.
I'm from Norway.
you
So
do have
that's
the
that's standard over there.
You do have these internal limits. The problem is with the pub, and the problem is with contactless payments, is that quite often you buy a pint, you don't even know what the price is, and then you get like £7.30, and you're like, wow. But the real, I'm in a real Jekyll and Hyde kind of areas when it comes to things like a pint. So I get skewed in Kensington because it's like £7.50 a pint, but in the local town that I live in, I'm only 30 miles away from London. I can still get a pint for £3.50 in a non-Wetherspoons pub. So I'll get kind of thrown out of kilter, but yeah, there is definitely limits. I would never ever pay that much for a beer, Georgie, and I love beer.
So yeah, I mean, it's all right, but I'd get a taster and that'll be enough. Simon for free. Simon, 25 million on a car. Do you know, if I had 25 million, I mean, even if I was Jeff Bezos, kind of 25 million, well, I don't think I'd spend it on a car. What can you get for 25 million for a car?
You can get the world's most expensive new car. Not the world's most expensive car, because there are existing classic cars that would have sold for more money than this. The Rolls-Royce La Rose Noire drop tail.
Right. Okay.
And the key to the price tag here is that this car is unique. This is a unique private commission Rolls-Royce 2-seater convertible drop tail, so it's shaped differently to the convertible Rolls-Royce that this is based on. And it has been bought, all we know, is by a super rich wife and husband from a glamorous, art-loving champagne and fashion dynasty who are described as the heads of a prominent international family with a deep connection to France. So it could be French.
Okay. It's very pretty. Look, it is a nice-looking car, and I don't say that often.
It is one of only 4 drop-tail Rolls-Royce convertibles that will be produced over the coming years. So the key to the £25 million price tag, despite all the fancy stuff on this car, doesn't make it worth £25 million. No. So the key to it is its uniqueness. There's only one of these. But also the key to it is how wealthy the buyers, who we don't know, are. And the combination of those two things means that there is the price of this. And what they've done is they have bought a trophy asset that they will probably hold on to for a very long time. And they are banking on its uniqueness, meaning that this will instantly become a classic car and instantly become a car that holds its value. It won't do that thing that happens if you or I were to go and buy a brand new car, drive it off the forecourt, and the price would reduce by about 30%. World's gone a bit mad in recent years, and that hasn't been happening with new cars, but we will return to the normal order of things, and that is the general vibe. They are betting that this will instantly become one of the world's most coveted cars, and that probably it might even already be worth more than they've paid for it. Now, will that happen? I don't know. I don't know whether this is a trophy asset of that level. Maybe it's now only worth 20 million. Depends on whether you can find a buyer for it, doesn't it? Because something like this is entirely based on the sentiment of overall buyers, and also just finding that one person who wants to buy it off you. Maybe there's someone who's seen this and gone, I wish I'd commissioned that. I wish I'd bought that. I'd pay 30 million for that right now just to have it. We don't know. But also, as I said, the key is, the wealthiness of the people buying it. And to us, £25 million on a car is just nuts. More money than we'll ever earn in a lifetime, richer than we'll ever be, all that kind of stuff. But actually, then if you start comparing it, it's the equivalent. Perhaps these people, whoever they are, they're very rich, right? It's talk of billionaires, okay? But but you don't spend your billions, but it's just your wealth that you've built up. But maybe they earn £50 million a year. And if they earn £50 million a year, then £25 million on a car is just the equivalent of somebody who earns £50,000 buying a £25,000 car. We don't consider that, particularly abnormal. Or actually, maybe it's the equivalent of somebody who earns £100,000 a year going out and buying themselves a Porsche Boxster. It's a £50,000 car, roughly. They earn £100,000 a year. Again, we might consider it a bit frivolous, but we wouldn't consider it completely abnormal. So, maybe it's just a similar thing to that. mean, the only thing I would say is that you would hope that anybody earning £50 million a year is paying quite a lot of it in tax. You'd hope they were paying a higher rate of tax than the person earning £100,000 a year. But weirdly, in the UK tax system, they actually wouldn't. The person earning £100,000 a year, if they earn an extra pound, would face a 60% marginal tax rate, whereas the person earning £50 million a year wouldn't face a 60% marginal tax rate. But that's a conversation we've had other times before and for another podcast. But they will be losing more of the money in tax, you would think. So it doesn't quite directly compare. But hey, look, rich people have got a lot of money and they want to spend it. I mean, Jeff Bezos and his yachts.
Yeah.
I believe, if I've read this correctly, Jeff Bezos is currently sailing around in a very green eco yacht.
Great.
That, doesn't damage the environment, but that it also may potentially being trailed by a smaller fossil fuel burning yacht that's like carrying the entourage and other stuff that's needed. But I might have made that up. So Jeff, if you're listening, I'm sorry.
I'm also
if it's not true,
confident when it was built, it probably wasn't the greenest. But either
if it is true, Georgie's going to tell you how you can drop us an email to confirm it.
Yeah, that's true. I'm also going to say I've got a slightly battered Vauxhall Mocha. I can sign it or something if anyone wants to offer me 25 pounds for it. Right, that's it. You can keep up to date with all the latest breaking money news. Just go to thisismoney.co.uk or download the app. And if you have any comments or questions as a team, anything you'd like them to look into, Simon?
If you want to ask us a question, or if you're Jeff Bezos and want to confirm your yacht situation, you can email us at editor@thisismoney.co.uk. Jeff, just to make sure we don't miss your email, stick yacht in the subject line if that's okay. Or you can tweet us at thisismoney, or come to thisismoney.co.uk/podcast to find all podcast paths.
And if you like our podcast, why not rate us wherever you found us? It helps other people find us too.
Don't forget, you can stay on top of what's going on in the markets by tuning in to the Digest and Invest podcast by eToro. Go to your regular podcast platform and listen on the go. Digest and Invest by eToro, the podcast for those interested in trading and investing.